Hello and welcome to my channel. In this series of videos, I'll be sharing how I've achieved consistent gains in my investment accounts using the OptionsPlay strategy. I'll walk you through the process step by step, showing you actual trades and profits I've made over the last couple of years. Whether you're a beginner or looking to refine your trading approach, you'll find practical insights and real examples here. Be sure to subscribe so you don't miss any of these valuable insights. Let's get started with Jim. Grow your money. I created this series of videos to share with my family, those who call me brother, dad, and uncle, how I've been achieving consistent profits over the past 2 years using the OptionsPlay strategy. I know that options can seem overwhelming at first, especially if you've never used them before. For my family, trust is key. I wouldn't lead them astray. While you may not know me personally, I invite you to follow along and take advantage of the same strategy I've been using with confidence. That said, this content is for educational purposes only. Always do your own research before making any investment decisions and consult with a qualified financial advisor if needed. If you find this content helpful, consider liking and subscribing to the channel so you don't miss future videos. And if you'd like to support my work, check out the Buy Me a Coffee link in the description. Your support means the world to me. Thank you. And let me just say this upfront, using the OptionsPlay strategy, I've doubled one of my accounts and achieved an average of 25% annualized returns across all of them. This strategy is forgiving yet powerful, and by the end of this video, you'll see exactly how I did it, and how you can start applying the same approach today. If you're looking for a systematic way to grow your accounts, you're in the right place. Now that you know what's possible, let's take a look at what we'll cover in today's video. Here's what we'll cover in this video. Minimum base of knowledge, the key essentials to understand before using the OptionsPlay strategy. Options and strategy, a simplified overview to get you comfortable with the basics. My timeline, a quick look at how my approach has evolved and the results I've achieved. Tools, the platforms and resources I rely on to execute this strategy effectively. Optimal trades, the criteria I use to identify the best opportunities. Walkthroughs, I'll introduce how I use these tools, with full demonstrations coming in future videos. Advantages and challenges, what makes this strategy powerful and the obstacles to be aware of. Mindset for success, staying disciplined and focused as you execute trades. Results data, a snapshot of what this strategy has done for me. Takeaways and next steps, wrapping up with actionable insights to help you get started. This presentation is designed to give you a clear, practical understanding of the strategy. Future videos will dive deeper into specific tools and examples, so don't forget to subscribe and hit the notification bell to follow along. When I first started investing and actively trading, I told myself to stay away from options, they seemed overly complicated and intimidating. But as I started using them more, they began to make a lot of sense. Before diving into the wheel strategy, it's crucial to establish a solid understanding of the basics. This means having at least 1 year of stock trading experience, or starting with paper trading to get comfortable with the process. If you're new to trading, I recommend starting with at least 1 year of stock trading experience. This will help you understand how the market moves. For absolute beginners, paper trading can be a great way to practice without risking real money. Options are derivatives, which means their value is tied to an underlying stock. If you've never worked with options before, don't worry, I'll simplify everything for you throughout this series. Each option contract gives you control over 100 shares of stock. This means you need enough capital to handle those shares, especially when selling puts, which we'll discuss later. The OptionsPlay strategy is focused on being an option seller, not a buyer. This gives us the advantage of collecting premium upfront, but it's important to understand how this differs from buying options. The Greek we're most concerned with is delta, which represents the probability of an option expiring in the money. It's a key factor in how we choose our trades, and I'll show you how to use it later in the series. When you feel you understand this content, you may be ready to start applying this strategy. It's not about rushing into trades, it's about building confidence in the process and ensuring you know what you're committing to. If you're still unsure about any of these points, take your time and review the resources I've shared, including videos from OptionsPlay, which helped me get started. Let's take a quick look at what the options will strategy is, and what it's not. What it is. First, this is an options strategy, one of many available. There are dozens of strategies out there, from simple to highly complex, but the options will stands out because it's straightforward, forgiving, and reliable. It's not a secret, the principles behind this strategy are well known, but its power lies in how you apply it. It can be time-consuming. You'll need to dedicate about 1 to 2 days per week if you manage it more passively, or up to 4 to 5 days a week if you want to be more hands-on. To use this strategy, a few things are required. You need to understand the basics of options. You'll need to have options trading approval from your broker. You'll need enough capital to purchase at least 100 shares of stock per option contract. And finally, you'll need patience. This strategy isn't about quick wins, it's about consistent growth over time. What it is not. It's not a get-rich-quick scheme. You won't become a millionaire overnight, but it is a reliable way to grow your account steadily. It's not completely hands-off. While some aspects can be automated, you'll still need to manage your trades. It's not necessarily easy for small accounts because you'll need enough capital to purchase 100 shares of stock. This can limit stock selection for smaller accounts. It's also not something you have to monitor continuously, just regularly enough to stay on top of your trades. And finally, it's not immune to market conditions. While this strategy can be forgiving, unexpected events in the market can still affect your trades. This slide is all about setting expectations. Among the dozens of options strategies available, the wheel strategy is one of the most approachable and effective. Now, let's dive deeper into how it works and what makes it so powerful. Let's take a moment to understand what options are and how they work. At their core, options are contracts between a buyer and a seller, where the buyer pays the seller a premium for certain rights tied to a stock. Think of it like an insurance policy. As sellers of options, we're like insurance salesmen. The buyer pays us a premium upfront for the right to take specific actions, like buying or selling the stock, at a predetermined price within a specific time frame. Just like insurance companies take on risk in exchange for premiums, we as option sellers take on certain obligations in exchange for the premiums we collect. Now, there's a lot to options, but I want to keep this simple. One key term I want you to focus on is delta, which is highlighted on the slide. In plain English, delta represents the probability that the underlying stock will reach the strike price by the option's expiration. This is a critical factor when we're selecting trades because it helps us assess risk and opportunity. As for the other Greeks, gamma, theta, and vega, I've included their definitions on the slide for reference, but we won't dive into them here. If you're interested in understanding these concepts further, I recommend the excellent resources from OptionsPlay, where experts like Tony Zhang and Jessica Inskip break them down in detail. For now, remember, options give buyers rights, sellers obligations, and both parties opportunities to profit. As sellers, we're focused on collecting premiums consistently and managing risks effectively. With a basic understanding of options in place, let's move on to the details of how the options wheel strategy works and how we can apply it effectively. Let's break down the key components of an option contract so you can understand how they work. Each option contract has 4 main elements. Date of expiration. This is the last day the option is valid. After this date, the contract becomes void. For example, if you sell an option with a January 19th expiration date, the buyer must act by then, or the contract will expire worthless. Strike price. This is the price at which the buyer can choose to buy or sell the underlying stock. For instance, if you sell a call with a strike price of $50, the buyer can purchase the stock from you at $50, regardless of the current market price. Underlying stock. This is the stock the option derives its value from. As an option seller, you need to own or be able to purchase 100 shares of the stock for each contract you sell. The stock must also be optionable, meaning it has options available for trading. Premium. This is the amount the buyer pays you upfront for selling the option. It's your income for taking on the obligation of the contract. Premiums are determined by factors like supply and demand, the stock's volatility, and the time until expiration. It's important to remember that as an option seller, you're taking on certain obligations in exchange for the premium you receive. If the buyer chooses to exercise the option, you'll need to fulfill the terms, whether that's buying 100 shares at the strike price or selling them. Understanding these components is key to applying the options will strategy effectively. For a deeper dive into option contracts, check out the resources I've linked in the description. Now that we understand the basics of option contracts, let's talk about the two types of options we use in the options will strategy, calls and puts. Think back to the insurance analogy. As option sellers, we collect premiums from buyers in exchange for taking on certain obligations. Here's how that applies to the two types of options. Calls for covered calls. This is like agreeing to sell your car at a set price if someone decides they want it. In this case, you're bearish, you believe the stock price will stay below the strike price. If it does, the option expires worthless, and you keep the premium. If the stock price rises above the strike price, you're obligated to sell your 100 shares at that price. But you still keep the premium, which reduces your overall cost and offsets some of the downside. Puts for cash-secured puts. This is like agreeing to buy someone's car at a set price if they want to sell it. Here, you're bullish, you believe the stock price will stay above the strike price. If it does, the option expires worthless, and you keep the premium. If the stock price falls below the strike price, you're obligated to buy 100 shares at that price. But again, you still keep the premium, which reduces your effective purchase price. The key takeaway is this: as option sellers, we're taking on obligations in exchange for premiums. Our goal is to manage these obligations strategically to maximize income while minimizing risk. As sellers, we need to ensure we're financially prepared to fulfill these contracts, whether it's selling 100 shares for a call or buying 100 shares for a put. I'll talk more about these requirements later. Over the past year, I've been telling my family I'd put together an explainer video, and I started working on these slides last year. I began using the options will strategy on June 1, 2022, while working full-time. Back then, my approach was mostly hands-off. I sold calls and puts and let them expire worthless before resetting my positions. This gave me consistent, yet modest results, with an annualized return of about 15.1%, compared to 4.94% for the S&P 500 over the same period. In April 2023, I decided to take a more active role in managing my trades. Inspired by the methodologies I learned from OptionsPlay, I began implementing their approach to buy back trades at predefined profit levels, around 80% for calls and 50% for puts. This adjustment significantly improved my performance, boosting my annualized returns to 25.2% compared to 16% for the S&P 500. This more hands-on approach has been both rewarding and eye-opening, and I'm excited to show you how I've applied it in this presentation and my trading examples. This graphic demonstrates why it is called the wheel strategy, which is a systematic process designed to generate consistent income by selling options. Let's walk through how it works, starting with the entry points, which depend on whether you're beginning with cash or already own shares. Start with cash. If you're starting fresh, the first step is to sell a cash-secured put. This means you're agreeing to buy 100 shares of a stock at a specific price, the strike price, if the option buyer exercises the contract. For this, you'll need enough cash in your account to buy those shares if assigned. If the stock price stays above the strike price, the option expires worthless, and you keep the premium, allowing you to sell another put. Start with shares. If you already own 100 shares of a stock, you can begin by selling a covered call. This means you're agreeing to sell your shares at a specific price if the stock reaches or exceeds the strike price. Selling covered calls immediately allows you to generate income while maintaining ownership of your shares unless the option is exercised. If you own less than 100 shares, you have a choice here. You can either buy more shares to reach 100 or sell your existing shares and start fresh with cash by selling a put. What happens next? If the stock price stays above the strike price after selling a put, the option expires worthless, and you keep the premium. Then, you can sell another put to restart the process. If the stock price drops below the strike price, you'll be assigned and buy 100 shares. At this point, you shift to selling covered calls to continue generating income. Similarly, if the stock price stays below the strike price after selling a call, the option expires worthless, and you keep the premium. You can then sell another call or restart the cycle by selling a put if you've sold the shares. The beauty of the wheel strategy lies in its flexibility. Whether you're starting with cash or already own shares, the process systematically generates income while helping you manage risk. In the next slides, I'll show you how to apply this strategy and what tools I use to make it efficient. To successfully implement the options wheel strategy, you need the right tools. I use a combination of platforms, and this chart shows how they compare in terms of cost and effort. OptionsPlay, for beginners, this is a great tool for identifying and managing trades. It will give you alerts and provide insights into trade setups and probabilities, making it easier to manage the strategy effectively. I will be trying out for the first time on how you can execute trades directly through OptionsPlay if you're using TradeStation, adding convenience to the process. They have a 30-day free trial. Thinkorswim, TOS, a robust, feature-rich platform offered by Schwab. It's free to use if you have an account and offers powerful tools for analyzing and executing trades. It requires a bit of a learning curve, but the effort is worth it for the insights you gain. You can get access to Thinkorswim by opening an account. TradeStation, this platform is a great option if you want a seamless connection with OptionsPlay to execute trades. I recently added it to my toolkit, and I'll be demonstrating its features in the upcoming walkthrough series and learning alongside you. You can get access by opening an account. Google Sheets, my trusted tool for tracking performance and organizing my trades. While it's free, it requires a bit of effort to set up and maintain. However, the ability to customize it to fit my needs makes it an essential part of my process. This cost versus effort framework helps highlight where each tool fits. Platforms like Thinkorswim and TradeStation offer a lot of functionality with some setup effort, while Google Sheets is highly customizable but requires manual input. I'll show you exactly how I use each of these tools in the walkthrough series, so stay tuned. This slide outlines the foundational methodology I've adapted from Tony Zhang at OptionsPlay. His explanation of this strategy is exceptionally well laid out, and I highly recommend checking out his video for a deeper dive. You'll find the link in the description below. I want to emphasize that while this approach forms a solid base, I don't follow it verbatim. Instead, I've made several adjustments to tailor it to my specific goals, risk tolerance, and account sizes. These tweaks have helped me make the strategy even more profitable over time, and I'll be sharing those refinements with you throughout this series. Let's break this down. Cash secured puts. Collateral: you'll need enough cash to purchase 100 shares of the stock at the strike price. Days to expiration: I look for options expiring in 30 to 45 days. Strike price at delta: I aim for a delta around 40, which gives a good balance of premium and probability. Management: I typically buy back the option at 50% of the premium or let it expire worthless if the stock price stays above the strike price. Words of wisdom: never sell puts on stocks you wouldn't want to own. Covered calls. Collateral: this requires owning 100 shares of the stock upfront. Days to expiration: I aim for about 45 days here as well. Strike price at delta: I prefer a delta around 15, ensuring I sell calls with a higher likelihood of expiring worthless. Management: I typically buy back at 80% of the premium or let the option expire worthless if the stock price stays below the strike price. Words of wisdom: never sell calls on stocks you want to keep long term. The key takeaway here is that understanding these fundamentals gives you the flexibility to adapt the strategy to your needs. In the upcoming walkthrough videos, I'll show you exactly how I apply these principles to my trades and where I've made adjustments to enhance profitability. To truly master the options wheel strategy, it's essential to see it in action. That's why I'm launching the GYM series of walkthrough videos, where I'll guide you step by step through the key aspects of this strategy. Here's what we'll cover. Managing the strategy: I'll show you how to adjust trades to maximize profitability and minimize risks. Placing trades: we'll go over live examples of selling cash secured puts and covered calls. Tracking performance. Learn how to monitor your progress and evaluate your results using tools like Google Sheets. Finding trades. Discover how I use OptionsPlay and Thinkorswim to identify opportunities. Paper trading. If you're just getting started, I'll show you how to practice trades without risking real money. These walkthroughs are designed to help you apply what you've learned in this presentation and build confidence in executing the strategy. Make sure to subscribe to the channel and turn on notifications so you don't miss these videos as they're released. As the series grows, I'll also be introducing new tools and advanced techniques to help you refine your approach. Whether you're new to options or looking to optimize your trades, the gym walkthroughs will provide actionable insights every step of the way. The OptionsPlay strategy offers several key advantages, making it a powerful tool for consistent income generation. Let's take a closer look at why this strategy stands out. Flexible and forgiving. The wheel strategy allows for adjustments if the stock price moves against you. Whether you roll options, hold the stock, or sell new contracts, you have multiple paths to recover or profit, making it far more forgiving than other strategies. Steady income stream. By collecting premiums regularly through selling puts and calls, you create a systematic way to generate income regardless of market conditions. Straightforward to implement. Once you understand the basics, it's easy to execute. This strategy is perfect for beginners looking for a manageable entry into options trading. Built-in risk management. With the requirement to have enough cash or shares to fulfill the contract, the strategy inherently limits your risk. You're never over-leveraged, unlike some speculative approaches. Control over outcomes. As the seller, you set the strike price and expiration date, giving you control over your potential outcomes and the ability to align trades with your goals. Words of wisdom: always pick stocks you're comfortable owning long-term. Remember, this strategy works best when applied to companies you believe in and want in your portfolio. The key takeaway is that the OptionsPlay strategy is a systematic, adaptable approach that works across various account sizes and experience levels. Whether you're starting with cash or already own shares, this strategy provides structure, risk management, and consistent returns. Let's talk about some of the challenges you may encounter when applying the OptionsPlay strategy. Getting directional view correct on puts. While the strategy doesn't rely heavily on predicting market direction, choosing the wrong strike price can lead to owning stocks you might not want. Small accounts. For accounts with limited funds, buying 100 shares can be a hurdle. This often limits stock selection and requires more careful planning. Selecting stocks and puts you want to own. This is a critical principle. Never sell a put on a stock you wouldn't want to hold long term. I'll share my data-driven approach to help you make these decisions. Taxable accounts. In taxable accounts, premiums collected are often considered short-term gains, which could mean higher taxes compared to long-term capital gains. Not immune to market conditions. While the strategy is forgiving, it's not completely immune to major market movements. Understanding how to adapt is key. Time management. Managing the wheel strategy can require a time commitment. However, with proper planning, you can tailor it to fit your schedule. The key takeaway here is that while challenges exist, they're manageable with the right mindset and tools. In the gym series, I'll show you how I navigate these hurdles to make the most of this strategy. Now let's talk about mindset, arguably the most important aspect of succeeding with the OptionsPlay strategy. Be satisfied with small gains. This strategy is about consistency, not home runs. Small gains compound over time to deliver impressive results, so celebrate the small wins. You don't have to win every trade. No one wins every time. The key is to manage losses when they happen and understand that occasional setbacks are part of the process. It's okay to get assigned. Getting assigned isn't a failure, it's an opportunity. If you've chosen stocks you're comfortable owning, assignment simply means you're one step deeper into the strategy. You'll get alerts from the brokerage when you're about to get assigned, but that is the essential piece of the strategy. Avoid overreacting to market swings. Market movements can trigger emotional decisions, but sticking to your plan will always yield better results than acting out of fear or greed. Focus on long-term consistency. The wheel strategy isn't a quick win, it's about steady, sustainable growth over months and years. Stick to the plan. Avoid the temptation to chase losses or deviate from your strategy due to emotional reactions. The structure is designed to keep you on track. Mastering your emotions is as critical as mastering the technical aspects of trading. I'll admit, I'm not immune to breaking the rules. I've had moments where I've won despite it and other times where I've lost. But each instance becomes a learning experience. When I break the rules, I reflect and tell myself, don't do that again, or occasionally, maybe I've discovered something worth exploring for future trades. This mindset, embracing mistakes as learning opportunities, is what allows you to weather the ups and downs while staying focused on the bigger picture. Let's take a look at the results I've achieved using the options wheel strategy. This tracker shows real data from my accounts over the past 2+ years. Here's the highlight: I've averaged 25% annualized returns across all accounts, and I even doubled one of them. In my walkthrough series, I'll show you exactly how I track and analyze this data, step by step. For now, let me give you a quick review of the key metrics and how they showcase the strategy's potential. As you can see, consistent premiums and careful management are the backbone of this strategy. The tracker keeps me accountable and ensures I'm making informed decisions. If you're interested in using a tracker like this, stay tuned for more details in the series. I will be providing a copy of my tracker as of today, January 11, 2025. This is just a copy so you can see all of the trades I've made over the last 2.5 years. I'll still keep updating this for myself and plan to share a copy of the tracker for the 3 different sized accounts for this series of videos, and if there is enough interest, I'll configure one you can use on your own accounts. Now let's dive into how I track my performance and results systematically using Google Sheets. This is a snapshot of my tracker, which has been a key tool for monitoring my progress since I started using the options wheel strategy. In the first column, you'll see the date, which I update daily. This allows me to monitor my portfolio on a day-by-day basis and analyze trends over time. The second column shows the total premiums earned since June 1, 2022. This is a running total of the income I've generated across all of my accounts from selling options. It's a great way to see the cumulative impact of consistent trading. The third column displays the premium earned on a specific day. This gives me insight into my daily performance and helps identify how my trading activities contribute to my overall results. Now, I want to emphasize that it's perfectly fine to skip days or even weeks if you get too busy. The wheel strategy is forgiving, and the income-generating opportunities will still be there when you return. You don't have to trade every day to be successful. Also, it's important to note that the premiums earned do not factor into the calculations for my annualized gains. The reason is that annualized gains are based on the overall growth of the account, not just the income generated. Premiums contribute to cash flow but are only part of the equation when considering how the strategy affects account balance growth over time. I'll explain more about how I calculate annualized gains later in this presentation. By tracking these metrics, I can evaluate the strategy's consistency and make data-driven decisions to improve my performance. I'll go into more detail about the other columns in the upcoming slides. In these columns, I've highlighted 2 key metrics: annualized returns and overall gains since June 1, 2022, which is when I started this strategy. Annualized returns are essential because they allow us to compare our performance on the same timeline as the S&P 500 or other benchmarks, essentially comparing apples to apples. This way, I know exactly how my strategy stacks up. I also track the S&P 500's performance during the same period to have a clear comparison. This gives me insight into whether my approach is outperforming or underperforming the broader market. As you can see, I've been able to achieve consistent gains that I'm proud of, and these numbers help me refine and improve my strategy. The key takeaway here is, tracking isn't just about seeing results, it's about holding yourself accountable and staying on top of your progress. This slide provides a detailed breakdown of the performance of 5 of my accounts, alongside the S&P 500 for comparison. Each account has 2 key metrics displayed. The shaded columns show the total gains since June 1, 2022. The columns to the right of each shaded column show the annualized returns for the same period. This comparison helps me evaluate how my strategy is performing relative to the broader market. For instance, you can see the S&P 500's annualized return during this time frame, giving me an apples-to-apples benchmark to measure against. I also want to highlight one of my accounts where I've more than doubled its value in just 2.5 years, demonstrating the potential of the wheel strategy when applied consistently. Let's wrap up this presentation with the key takeaways. First, as option sellers, we take on obligations. For puts, we commit to buying 100 shares if assigned. For calls, we agree to sell 100 shares if the stock reaches the strike price. The options wheel strategy is a systematic and flexible approach to generating consistent income. Whether you're starting with cash or already own shares, this strategy helps you manage risk while growing your portfolio. Remember, success requires patience, discipline, and a focus on long-term growth. Start small, use paper trading or a single trade to gain confidence and refine your process. Next steps. Follow this series for detailed walkthroughs of tools like Thinkorswim, TradeStation, and OptionsPlay. Subscribe to stay updated with new videos and examples. Engage with the community, drop your questions or share your experiences in the comments. I'd love to hear from you. Thank you for watching, and I'll see you in the next video.